in truck cabins. In the pre-open, it's already up about 10%, so we'll see how it plays out. But we're starting off on a bit of a cautious note, which was expected given the sell-off in global markets. So for the start off, the Nifty is down about 55 to 60 odd points. We're clocking levels around 19,444, 445, thereabouts. The key question is going to be, will this Friday dip get bought? It's very early, but let's see. The Bank Nifty is down about 170 odd points. That's a cut of about 0.3%. Mid-cap index also starts off a little soft. So where is the pressure? Well, a couple of pharma stocks are starting the day on the lower side. Cipla, Dr. Reddy's, Divi's, these are stocks on the lower side. Bajaj Auto is seeing a little bit of profit taking as well, but just about 1%. So it's not a big slide, so to speak. ICICI Bank, Infosys, HCL Tech, TCS, these are some of the other big boys which are starting off on the lower side. Technology is weak. That's one very clear trend as things stand. On the upside, Titan is sparkling on that good Q1 update. Reliance is positive because of the Geofinance demerger moving a step forward, as we just discussed. iShares, well, I don't want to speak too soon. It's a little tiny speck of green that we're seeing on iShares after 3 days of incessant selling. But it's hardly anything. It's just 5 rupees right now. So let's see where it goes. The Nifty is trying to pull back. Largely, it's Reliance that's doing the heavy lifting. Lever and L&T are very flat. Actually, barring Reliance, nothing else is supporting right now. Reliance single-handedly is trying to power through for the bulls. Banks are yet to pick up, and IT is a big drag as we start the day, guys.
Well, for the broader markets, there are a few stocks that are doing quite well. Zen Technologies, they won an order of close to 130 crores, so that stock has opened up well in the green. Sobha should come up for you in the screen. There was no volume growth, though we had the 5th quarter of record high bookings. That stock, in fact, has opened up in the green, up close to around 3% as we speak. Pre-sales was up 28%. Phoenix Mills as well. We're expecting a green tick out there. Retail consumption was up 18%. Retail collections was up close to around 18%. High occupancy as well at St. Regis and the other couple of properties that they have. So that as well gets a green tick. So well in the green. Kalyan Jewellers, well, the consolidated revenue growth for the first quarter was up 31%. And in the India operations, it was up 34%. So that stock as well, I think the initial tick was up close to 4%. It's holding in the green as well. So, Bros, as you pointed out, the government approved the draft notification to mandate the installation of AC systems in truck cabins. Flying away, 8.5%. I think the last 1 month, if I'm not mistaken, it's up close to around 40% or even more. As to DM, some reports indicate that maybe they're looking at getting a business partner, a PE, for their India business. Remember, we're waiting for the Middle East business to see a sale out there. But now these reports are indicating that maybe in the India business as well, they want to unlock some value. So let's see how this plays out for the time being. The stock is up close to around 3.5%. But on the index, the initial dip has got bought into. Sustaining this is going to be very, very crucial. The low of the day is close to around 19,450, 19,420. So we're off 30 points from the day, low point of the day. Can we hold on to this? That's going to be very, very important. Rima.
I was looking at Cipla because it opened sharply lower, but since then it's managed to trim some of its losses. There were some reports, I think Bloomberg was quoting how Cipla has recalled 6 batches of their inhaler albuterol in the United States because there was a complaint of one single inhaler where leakage was observed through the valve. So Cipla opened in the red, as you can see at 9:15. The cut was more than 1%, but since then it's recovered. It's official now, okay? So Cipla has officially, announced that they have recalled 6 batches of their inhaler albuterol. The reason the markets are actually under pressure is ICICI Bank and HDFC Bank. ICICI Bank has opened with a cut of nearly 1%. And remember, this has a nearly 8% weightage on the Nifty. And that's putting pressure even on the banking stock. ICICI Bank and even HDFC Bank is a bit subdued in trade. That's opened with a cut of close to about 0.5%. There you have that contribution played. On the gaining side, Titan, Reliance is only now contributing 3 points to the up move. The drag is courtesy ICICI, HDFC Limited, and then you throw in some IT names. NBFCs are selling off, but they run up so hard last month. So M&M Financial, you've got an AU Small Finance Bank, L&T Finance Holding. So a clutch of NBFCs and some of these SFB, smaller banking names, are a bit subdued in trade. And keep your eye on Intellect Design Arena. That's opened with a cut of nearly about 2%. There was news about the companies announced it to the exchanges, how they used to run this GEM, Government E-Marketplace contract with the government. They've been doing it since 2017, but then the government asked for a fresh request for proposal. When it had to be renewed, and at that time, Intellect Design Arena submitted a bid which is higher than competition, so therefore their GEM bid contract has now been terminated, so there will be some impact on their revenues. As of FY23, this GEM contributed 11.5% to the top line, but hardly 2% odd to the overall EBITDA. So Intellect is a bit on the back foot. But go ahead.
Rima, I just want to point out, apart from some of the IT names that you mentioned, FMCG is a very interesting trend for me. Look at Dabur. Now, Dabur came out with what seemed like a very strong first quarter update. They were sounding very, very optimistic on the rural market. The stock isn't reacting. But you have the jewelers, and that's where the buyers are gravitating, whether it's Titan on the large cap side or even Kalyan Jewelers. So very, very interesting trends. Yesterday, Marico was down because they sounded weak in terms of their first quarter update. Very interesting, very divergent trends across the FMCG/consumption universe. It's more of the discretionary consumption where the buyers seem to be, at least for the time being. Well, the market is still down 50 points. The Nifty is dealing with that cut. And while the bulls make up their mind about what to do next, let's welcome in our next guest on the show. Sunil Singhania, founder of Abacus Asset Management, is with us this morning. Sunil, thank you so much for joining in. Always a pleasure having you on the show, especially when it's a Friday. The spirits are high, even though the market might be slightly down. But you tell us, Sunil, it's been a phenomenal rally. And up until this morning, the market has ignored all kinds of, negative cues from global markets, fear of more interest rate hikes in the US, etc. My question to you is that is a melt up a real possibility just because of the sheer momentum of liquidity that's coming in? Or do you think, the time is ripe to start taking some profits and maybe kind of get on the sidelines?
Well, thank you for having me, Surbhi. And obviously, it's always nice to have a good market. And obviously, it's very nice to be seeing Friday on the calendar. See, as far as liquidity is concerned, obviously, liquidity does aid markets. But liquidity can aid the market only for the near term. I think we have to also realize that it is also a function of the differentiating fundamentals which India as a country has been witnessing over the last couple of years. So, we always say that in 22, when the world was debating whether there will be a recession or 0% growth, in India, the debate was whether we'll grow at 6% or 7%. And we ended up growing at 7%. All the macroeconomic factors have turned out to be positive. The concern about monsoon is also allayed significantly, with the deficit being cut almost to negligible levels. And corporate profit generally have been pretty good. And the indications which we are getting from early, sort of numbers as far as June quarter is concerned, whether it was banks, advances, even now the jewelry companies reporting and even some of the consumer companies reporting clearly indicate that as an economy also we are in a very good position. And I think lastly, we should not forget the fact that, the crude is at $75. And that would mean that the balance of payment for India would have never been as good as it is today. So I think, yes, there is liquidity. And yes, there has been an uptick in the market, which has been very sharp over the last 3 months. But it is backed by fundamentals. And lastly, year to date, we are up like 5-6%. It's not that we are up majorly, So if you see 23, we are up like 6% on the Nifty. It's only from the bottom of March, we see that Nifty has moved up maybe 15%. But year to date, we are up only 6-7%.
Got that. We're still underperforming most of the emerging markets on a year-to-date basis in dollar terms. Sunil, morning, and thank you very much for joining in. This market is great if you're already in the market, right? You've already been investing systematically for the last couple of quarters, years. But for a fresh entry point, is this an attractive entry point, or do you think it's too overheated to get in? Because at the end of the day, even the price at which you enter matters.
So, you answered your own question. The moral of the story is that be invested regularly, irrespective of the levels, and you won't be disappointed. If you just look at timing the markets, I think you missed the bus in March because, the investors were too concerned about what was happening on Silicon Valley Bank and Credit Suisse and so on and others. And now, you're worried that markets have moved up. So, if you just keep on worrying, you will always be on the sideline worrying when to enter. Yes, we are also of the view that there is one pocket of the market, particularly on the smaller companies, which is overheated. There is definitely a fear of missing out, which is also creeping in. And one has to be careful. But, we are in the camp which would say that the market might react 3-5%, but we are not going to see a major correction. So I think if you're a fresh investor, maybe, you put in 25, 30, 40% of what you want to invest now. And pray that you will get a correction.
Hi, Sunil. Good morning. Sunil, what about from the broader markets? We're still far away from that euphoric stage.
Nigel, what is euphoria? Euphoria is when P's become 30 and 40 at the Nifty level. We are at like 19 times, on the Nifty side. And at least our view is that for a change, the next the next 2 year earnings might see an uptick, which will be more than what we anticipate. So we are not in a euphoric stage as far as the market is concerned. As I said, some pockets, particularly smaller companies, are seeing that maybe scenario, but overall at a overall market level, I think we are maybe 10% overvalued, but not definitely in a euphoric stage.
Okay. So, Sunil, you've made it pretty clear that you find this rally to be qualitative. You're looking to remain invested. So let's come down to the areas. If someone's going to put fresh money to work now at these levels, at these all-time highs, then where do you look? Autos have had a great run. Banks haven't performed that much. I mean, just comparative to the Nifty. Then there is IT, where there's general sort of bear camp congregating. So broadly speaking, which are the sectors where you think fresh money can be put to work?
So, I don't think my views are going to change from the last time I mentioned to you and the previous. I think it remains the same. The other thing is, India is a country which is very diversified. We have presence across sectors. We have entrepreneurs who are at work, again, across sectors. And, unlike, market performances definitely don't mirror the views. So, you mentioned about IT, that, everyone is definitely a little bit sanguine about IT, which is rational also given the slowdown which we are seeing. But actually, if you see year to date, some of the IT stocks have been great outperformers. So, a lot of times the view on the sector is already discounted as far as the markets are concerned, both on the positive and the negative side. We are definitely in the camp which believes that banking should start to perform. And it's a good 2-3 year play. Credit growth has been very strong, and the initial numbers announced by most banks clearly point to almost 18 to 20% growth in advances. NPAs are non-existent. Yes, there has been a little bit of increase in interest rates, but I think that is more or less factored in. And from here on, we might see some relief as far as the interest rate is concerned. At least we are in that camp. So I think financials obviously look pretty decent. We are also of the belief that discretionary spend should pick up. April to June was not great. But, come the festive season in the second half of the financial year 24, we are very optimistic that discretionary spend will pick up in a major way. And I think that is where we are invested. Capital goods, again, is a great theme, great sector, though the stocks are not very cheap. So one has to be very careful. And in a very small theme, I think steel is something which we like selectively, though China has not been growing the way people expected post the reopening of the economy. But I think steel is one place where we believe that Indian companies have a great moat. Their integrated balance sheets are very clean. So in a small sector, I think steel will be something which we would look at. Pharma, looking at it, not jumping into it. But again, valuations there are now much more reasonable than where they used to be.
Why are you not jumping into pharma as yet? What's keeping you on the sidelines?
So pharma, as a sector, obviously has become cheap, but stock specific, one has to be very careful because, there is a enhanced sort of scrutiny as far as regulatory issues are concerned. And you don't want to get stuck because we have seen that even a small regulatory news flow leads to like a big move up and down as far as pharma is concerned. So we are equal weight. We have not gone overweight, but there are some companies which we believe will get an opportunity in the next 3-4 months.
Sunil, what about the railway theme? That has played out very, very well. And I think you all latched onto it very, very well as well. A couple of stocks are on public domain as well, Titagarh Wagons, I think. So how much of the good news is in the price for this entire railway theme? Because it's got a long runway. The kind of moves that we're seeing from the government of India as well, the kind of importance that it's being given. So your view on that space, capital goods we got. What about the railway theme?
No, I think railway is again something, there is a lot of spending happening. In fact, I traveled by the Vande Bharat for the first time 10 days back and I was pleasantly surprised. And we had some exposure, but Nigel, very frankly, we could have had more than what we had. But we also did not anticipate the kind of ordering which we saw as far as this sector is concerned, and will continue to be in this sector. So we are having some exposure. We are also looking at some indirect ways of playing this theme. I think there is a huge tailwind, and I would say that remain invested. Though some of the names which you mentioned, I think now a lot of what is going to happen over the next 2-3 years is sort of already discounted.
So at the index level, you're saying we're probably overvalued by 10%. But where are the pockets where the overvaluation is far more, where valuations have run ahead of fundamentals and you're uncomfortable?
So, as a fund house, we are very value conscious. So there are a lot of sectors where we are uncomfortable, but being uncomfortable does not mean that the price will fall, right? So there are investors who are willing to take that call of 4-5 years of rapid growth. And there is justification maybe, for companies which have moved up quite sharply. So we must stay away from fashion or themes. We are, I would say, slaves of numbers. So wherever the valuations are 50, 60, 70 PE with growth of only 10, 15%, we tend to be a little cautious. But where there is growth of 25, 30% expected, we don't mind paying even 30, 40 PE multiples. So, it's very simple, just look at the valuations and the growth rates. I think if the valuations are like 4 or 5x of the expected growth rates on an annual basis, I think those are the sectors, theme stocks, which we will stay away with.
Okay, all right. Sunil, a final question before we let you go. What about IT? There's a debate out there in terms of how to approach this space. There are a lot of risk, but I'm looking at some smaller stocks. They're up 20-25% from the recent lows as well, after correcting a goodish bit from mid-cap IT. How are you all approaching this theme? Stay away, or do you still believe that someone who wants to buy it for a little longer duration, they should be getting in if in case things get a little rocky?
So, Nigel, I've seen the market for a long, long time. And, when the market scenario and sentiment is good, there are investors who wait for negative news to latch into it. And therefore, we are seeing that even on negative news flow, stocks are not correcting, because right now the mood is towards investing in India from a 3, 4, 5 years perspective. And it's not only local investors, even global investors. I have been traveling across the world in the last 2-3 months. Our theme of dragon to elephant is for real. We are seeing money definitely look at India and away from some of the other larger countries. In IT, yes, June numbers might not be that great. Maybe September also, I don't know. But valuations have been pretty decent for some of the larger companies. You don't get 100% cash conversion companies who distribute 80-90% of their profits available at sub 20p. And that's the reason why they've been consolidating. And some of the smaller IT companies continue to grow much faster because they're in niche segments. So I would say that, it's a sector where India has global competence. But at the same time, I do agree with the view that June and September quarters might not be that great. But, at decent valuations, I think this is a sector which can be a good part of your portfolio and which can be a good, like a 15% compounding kind of a sector.
Always good hearing your thoughts. Sunil, thanks so much for joining in and filling us in with your views on the markets as well as the individual sectors that we discussed. Wishing you a good Friday ahead.
Thank you.
Well, the markets have almost moved into the green. That initial dip has got bought into when we were having that chat with Sunil. We were down close to around 60-70 points to kickstart trade, but we're almost back in the green. The mid-cap index, that's where the action is. That's already back in the green. And just to point out a few stocks, South Indian Bank, the volumes are massive out there. The stock has moved to the high point of this, so keep an eye out on that one. Rainbow Medicare as well, that's the other one, the children's focused hospital. That one's doing quite well. Volume's quite high on that one. And Suntech Realty, for the second day running, well, that's doing well. It's up close to around 10% in the last couple of sessions. So keep an eye out on that one. Has been a bit of an underperformer, but that's moving up as well. But let's move on. CNBC-TV18 had polled 30 fund managers on where the market is headed in the second half of this year. What are the risks and which sectors will be the leaders? Well, Surbhi has some findings of this very interesting survey. Surbhi.
Well, thank you so much for that. Very, very clearly, with the markets, of course, having done what they have in the last 3 odd months, we felt the time is right to really do a poll, a dipstick study of the street. And you'll be looking at some very interesting takeaways. I'm going to start with the first question. Very basic question. Is this market heading higher in the second half of 2023? This is a bit of a non-surprise, right? The majority, 76%, almost 77% feel that, yes, we're heading higher. Let's get to the second question. Where will the Nifty end by the end of the calendar year? And here things are quite interesting. The majority, which is nearly 42%, feel that the Nifty would be between the 20,000 to the 21,000 mark. The next biggest respondent group, that's just about 21% of the respondents, they feel the Nifty could be between 19,000 to 20,000. Maybe they'll be reworking that assumption because we've crossed 500 points in just the last couple of days. Actually, very few, just about 10%, interestingly, feel that we'll rally beyond 21,000. So people are still sort of holding back in terms of looking at a melt-up sort of a scenario. Let's see, how that plays out. Let's move to the next question. The next question is, which sectors can lead the rally? Now, here the near consensus, almost complete consensus, is on banks. And the reason why you're seeing those percentages not adding up to 100 is because this was a multiple choice question. So you can pick more than one sector. The overwhelming majority feels that banks are going to lead it from the front. Banks have underperformed the Nifty by about 2-3%, remember, from the top of the year. The auto sector, despite rallying 22% in the first half, still is getting respondents, almost 46-47% saying that we'll see the auto rally continue. There's positivity around pharma. Interestingly, look at IT. We all know about this big debate around IT, and it's not been, it's not expected to be a great first quarter. But despite that, 40% still feel that IT can be a good contributor. Now let's move on and talk about the Bank Nifty, because you saw in this question that people feel banks will lead the rally. So where will the Bank Nifty be as we get to the end of the year? Now, almost 40% of the respondents feel that the Bank Nifty will be between 45,000 to 47,500. 21% actually see it heading even above 47,500, which would amount to about a 5% up move. Almost no fund managers expect any meaningful correction in the Bank Nifty in the second half. By meaningful, I mean more than 10%, because that number is 3.6%. People who are expecting a 10% correction in the Bank Nifty. Let's move on. In terms of market capitalization segment, which segment will lead? Here is pretty interesting. So fund managers are saying it could be large caps or small caps. Because look at this, 48% believe large caps will lead the market, 41% feel it's small caps, mid caps actually only 10%. So the money is moving to either the big boys or the real small boys. That was an interesting takeaway as well. Moving on to the next question then. Which segment will lead inflows into the market? And here the consensus is both. FIIs and DIIs will keep the taps flowing, and that should lead to more upsides in the market. The next question then. Will we see heightened IPO activity? No surprises here as well. The majority, almost 69-70% say yes, expect more primary market action. The next question, let's talk about macros. We threw in some macro questions as well. So GDP expectations for FY24. The majority feels that India will look at a 6.25% GDP growth this year. The next biggest group of respondents, that's about 20% respondents, feel that we'll be at 6% GDP growth. So basically, the bulk, 37.9, 20% put together, they feel the GDP growth this year will be between 6% to 6.25%. The outliers, that will cross 6.5%. That's a very small, percentage. Just about 13 to 14% feel that we will grow above 6.5%. Which brings us to the rate hike question. What will the RBI do this year? The majority feels will not see any change. No cut and no increase. That's almost a 48-49%. Some do feel that we might get a 25 basis points cut. This was interesting. 40% do feel that there is a chance of a cut. That's a probability. With that, let's move to the next question. Will we see more block deals? Remember all this intense, block action that we've seen, whether either promoters, quasi-promoters or early stage investors, they've been selling out. And yes, the market men, the money men are telling you, expect more block action. Look at that, 90% expect more heightened activity in the block window as well. The biggest risk, then we said, okay, the consensus seems to be we're heading higher. So what could be the biggest risk? Interestingly, it's actually more global. So either a US recession, global recession, or global geopolitics. So you see top two tabs over there, 30% and 30%. Interestingly, even local elections are a bit of a risk. I mean, that's not a given, so to speak, the outcome over there. So that's about 20%. Monetary policy, not so much of a problem. And poor monsoon actually is not top of mind. So it seems that this whole El Nino fear and the fact that we didn't get so much rainfall in June, that's not really standing out as a risk when it comes to the 30 fund managers that we spoke with. Back to you guys.
Okay, very, very interesting there. Thank you very much, Subi, for highlighting that. Harish Krishnan, EVP, Senior Fund Manager, Equities at Kotak AMC, is now with us on the show. Harish, which camp are you in? Are we going to clock at levels above 21,000 by the end of the year? Are we going to be settling in between 20 to 21,000? And I want to throw in one more question. I think the big fear in the market is that are we close to topping out? And based on the past precedents and historical levels, can you give us the indicators when markets usually top out and where are we compared to those?
Sure. Clearly from index levels, I don't think really we have any kind of a insight as to what it's likely to be at the end of the year. We do think that markets have run a bit ahead of themselves. And our best guess would be that we would be in a range-bound market towards the close of the year. But that's just a guess at this point of time. I think the more interesting question that you had was, with markets at all-time highs, what is it that one should do, and what is it that the historical evidence seems to suggest? So, firstly, I would say that all-time high is obviously just a statistic. So if I were to look at, say, the last 17 odd years from 2005 to 2023, where there have been about 5,000 odd trading days, Nifty, for example, has been at all-time high levels on 500 of these trading days. So that's a lot number of trading days that we've all celebrated and cheered from and benefited from as we have seen our wealth increase. There have been under 500 odd trading days where markets have been just about 1% below their all-time highs. So in totality, we are talking about 1,000 out of 5,000 odd trading days, almost close to about 20% of the total number of trading days where markets have been close to all-time highs. So therefore, it is not that, one should specifically look at all-time high at this point in time to really think about as a key decision-making variable. Of course, what is more important is that I guess for most investors, whenever we come through this all-time high, the fear is always that, are we going back to the 2007-8 kind of a level, wherein, of course, we saw a massive drawdown and it took a lot of time to recover. But leaving aside that one episode, on a general sense, drawdowns are inevitable. They do happen, but they have become a lot more shallower, especially over the last 5-7 years, due to flows, due to better earnings, the better perception of Indian companies and the Indian economy, et cetera, et cetera. So now that's the historical evidence. I guess what is important is also to look at the current context of where things are. I think in the current context, we have gone through a phase where in the last 18 months, whatever macro curveballs can come up against, we've kind of dealt with it rather in a better way than what we would have imagined. Crude at 125, a big interest rate spike globally, a big inflation scare globally. You had a huge war that got erupted and continues in Europe. Any of these prospects by themselves would have meant a significant kind of a volatility in Indian markets. Together, we've dealt with it quite well. And which means that, a lot of the froth has gone off over the last 18 months. Yes,
Right.
The only issue has been that, there has been some kind of an inch back in valuations. And therefore, the best sense that we have is to maintain asset allocation. We have various asset allocation products out there that help in trying to, get in when markets are cheap, and then to kind of rebalance as when markets are expensive.
All right. Hi, Arish. Morning. Talking about asset allocation, how much are you all allocating, say, into equities in your balanced advance funds? What is it now? What was it? And, what's the normal average that you normally allocate out there?
Right. So, Nigel, our balanced advantage fund typically operates between 20% to 80%. Just to give you a sense, in September of 21, which is when markets were at all-time high in 2021, we were at about 30 odd percent. So we were close to the lows at that point of time. Then during the course of 2022, when crude rallied to 125 and the Ukrainian war got announced, and FIs were selling almost every day to the tune of 3,000 to 4,000 crores, we increased that to close to about 55%. Subsequently, markets rebounded nicely, and then we booked profits and brought it down to 40% by November of 22. And then when the Hindenburg episode happened, markets again corrected, and we had increased it to about 55% in March of this year. At this point of time, we are close to about 48, 49%. So we booked some profits, but that is at least our sense as to how we are looking at markets at the current context.
Harish, before we let you go, we're talking about all-time highs. We're talking about a fantastic market and large sense of optimism. I just want to get your sense on the inflows that are coming into mutual funds, because that is the only number that's not been inspiring much confidence. April was bad at 5,000 crores. May was worse at just under 3,000 crores. We'll get the June numbers now next week. But what is your sense? Is there a lot of profit taking or redemption that's happening at at mutual funds? What's your sense? I mean, or is the retail participant going direct? And that's a different story that's playing out as the market scales these levels.
So, Sobhi, we've seen this over the last 18 months. For example, even in October, November of last year, when markets scaled back to their all-time highs, at that point of time, flows became very less. Essentially, the way we look at flows, there is, of course, the systematic investment plan, the SIP flows, and then the lump sum flows. The SIP trend continues to remain very strong. We continue to see steady growth over there. It's the redemptions from the lump sum category that actually pulled down even at that point of time, and we are seeing the same thing happening now. And the good thing, of course, is that the Indian investor is maturing quite well, wherein when markets did correct, for example, when we saw it in January and February of this year, they did bring in a lot of flows in the lump sum category as well. So I guess there is some element of timing that a lot of investors themselves are doing in, and which I would think is a wonderful kind of a journey of investor maturity that we've seen, that they continue to maintain their systematic allocation levels through SIPs, and then basis their goals, basis their assessment of valuations, they are also trying to kind of move up and down in terms of their lump sum allocations.
All right, Harish, always a pleasure speaking with you. You have a great day, fantastic Friday ahead, and we look forward to the next conversation. Time to take a break with the headline that the dip has been bought. The first dip has been bought. The markets come back to even ground. We'll take a break. We'll come back and we'll get some corporate conversations going as well. Amit Agrawal, Group CFO at Raymond, is going to join in to talk about the business outlook. And then we put the spotlight on the IT sector. Q1 FY24 is upon us. So our special segment, Quarter Se Quarter Tak, kicks off with a curtain raiser on IT earnings.
Welcome back. This is Corporate Radar. Markets have almost moved into the green, trading around the flat line, Nifty as well as the mid-cap index. In just a short while, we'll get the IdeaForge listing price. Remember, the IPO was a little below that 700 rupees odd. But the IdeaForge, I think initial, the number that we're getting is closer on 1,300 rupees. So that would be nearly doubling your money if you got lucky to get allocated in that IPO. That number will come up for you on the screen in just a bit. So we'll watch out for that. But let's focus on another company, Raymond. Incred, well, they have initiated coverage on Raymond with an ad rating and target price of 2,200 rupees per share. The brokerage believes that Raymond is well placed from a growth perspective led by changes in leadership. They also say the sale of the non-core FMCG portfolio at rich valuation, that's driven the company to move into the net debt-free status. Amit Agrawal, the group CFO at Raymond, joins us on the show. Hi, Amit. Good morning. Thanks so much for joining in. Well, the stock has done very, very well, so things get even more interesting from here on because the hopes are high. Give us a couple of details. How's the wedding season panned out? And also, you'll have festive season in the second half of this year. So are we bracing for a softish first half of the year, or are trends still looking up?
Thank you. No, it has been a very interesting journey for us. In the last 3 years, we have been able to achieve a lot of ground. And you see, with the FMCG transaction, we have become not only net debt free, rather we are sitting with more than 1,500 crore of cash with us for the growth of the business. If I talk about the first quarter, you see the weddings, which we normally tend to see in the rural sector, especially in the summer season, has been little slow because of the 2 or 3 reasons, which we all are well aware that in the February and March, there were some rains which had impacted the crop. And that is why some of the people have been little bit less in the mode to spend money. Second thing, the heat wave, which was there in most part, especially in the North India, also led the people to avoid weddings and shifted some of the weddings from the summer to winter. However, overall, if I look at it, some of the other categories have done decently well for us. So we are seeing a balanced quarter, and actually always the first quarter is always a slower quarter, seasonally weaker quarter. So to that extent, we feel quite satisfied in that quarter. But as you rightly pointed out, I think the second half looks very, very strong. I think people are expecting once again a very strong festival season, and our dealer franchisee network, they all are seeing that the festival season as well as the wedding season would be very, very good for us.
All right, Amit, you mentioned about the net cash position. I just want to ask you a couple of questions out there. You got to close on 2,800 crores for the FMCG business. Some of that would have gone in taxation. You've done some CSR activities, I believe, of around 50-60 crores. Now, removing the debt from it as well, you have 1,500 crores. What do you do with this debt? And tell us, you'll be having 2 listed entities soon, right? Who
Yes.
gets this money? Which entity will sit? Because 1,500 crores of net cash is what you will be having.
Yeah, so let me give you the full picture about that. So we sold the business for 2,825 crores. And after paying tax and everything, we are left with 2,200 crores. And if we see the demerger of the lifestyle business from Raymond Limited will go into that FMCG company, which will go along with a debt of close to 1,800 crores. So to that extent, 1,800 crore against the 2,200 crores. So you will have 400-500 crore based on the current position, cash in the lifestyle business in that FMCG company, and the balance 1,000 plus crores we will have in the Raymond Limited, which is primarily the real estate business as well as the engineering business and the corporate, which we want to take it forward and grow some of the other businesses as well.
Okay. Amit, that's really helpful now that you've given us the breakup of the cash. So next logical question is, what are you going to do with the money? I mean,
Yes.
is there, will there be perhaps a bigger dividend, special dividend this time around? Anything else that you're planning? You also, of course, have, CapEx plans with your ethnic wear brand. So just give us a breakup. How much cash goes into the business? What part of the business? And if there's any other way in which you can reward your shareholders.
So look, as far as the money is going to be spent, we have chartered out a significant growth plan for the lifestyle business. As mentioned earlier also, we are opening in the next 3 to 4 years over 500 stores, especially the EBOs, in order to drive the growth. So that will be both for our apparel brands, be it Park Avenue, Raymond Ready to Wear, Color Plus, as well as ethnic stores. So that will be one, but most of it is a franchisee-led, so we are not putting a large capex out there. The large capex which we are planning to do is already in place, is close to 200 crores, which we are spending money on the garmenting business, the B2B for white label. As you know, the China Plus One is helping the country as well as us in a very large manner. We are expanding our capacity by 1/3 so that we can cater to the increased demand from both US and Europe. So that's again a large capex. And plus all our businesses are having a significant cash flow generations. So our idea will be to deploy this money, because as you increase the revenue, there will be an increase in the working capital, not obviously the number of days. So this will be primarily used for the business in order to take it to much higher level and grow the lifestyle business, because we see a lot of opportunity in our home textile business. We see a great opportunity in the shirting business, which we want to expand. Third is the ethnics business, as we have begun opening stores. Last year, we opened almost 65 stores, and we also plan to open more than 100 stores in this year.
Okay, Amit, give us just a targeted revenue mix as well. I mean, you described all the businesses and you're deploying cash. So let's say between the apparel business where you're putting up fresh capacity and, home textiles, denim, if you sort of just break up the revenue pie in terms of what is your targeted pie for end FY24?
So look, end FY24, we are still considering that the lifestyle business, which is relating to fabrics, apparel, garmenting, that business will contribute close to 70% of the revenues, and the balance 30% of the revenues would come from the real estate as well as, engineering business.
Okay. All right, Amit, got that. Thank you very much for joining in and giving us a sense of how you're looking at things for the rest of the year. We look forward to more conversations as we go ahead. Well, with that, let's move on. As we promised, it is time to kickstart our quarter tak series. We get you a curtain raiser on all the key sectors and the expectations ahead of the earnings season. And as usual, it's going to be the IT companies which will kick it off. TCS and HCL Tech will be reporting numbers on the 12th. Rima joins in with a highlight of the expectations. Rima, I guess no one's holding out the firecrackers for IT this time, right?
Nope. Q1 FY24 is expected to be weak despite the strong seasonality which typically takes place in the June quarter. What's hurting? Uncertain macros have led to a cut in discretionary spending. Projects are getting deferred. Some of them are going to get cancelled. And this is likely to result in a revenue decline for Wipro and Tech Mahindra. We're expecting a flat revenue growth for both TCS and HCL Tech, while Infosys could clock in a constant currency revenue growth of 0.7% on a quarter-on-quarter basis. And just to put it in context, typically the June quarter is very strong, and last year all these companies grew between 2 to 5% last year. Moving on to margins. Now, margins are likely to remain depressed despite the easing supply-side challenges, and that's on account of weak operating leverage. Margins for, margins for Tech Mahindra and TCS are likely to show a sharp decline. That's on account of wage hike. But for the others, it's expected to remain on the flatter side. The silver lining in the quarter is going to be the strong deal wins and the order pipeline. Most companies, in fact, have announced very large deal wins. For TCS, for instance, there was this $1.8 billion BSNL deal. There was a Standard Life deal. There was Marks and Spencer's deal. Infosys, if you remember, had announced a very large, nearly $500 million deal with a Nordic bank called Danske. And even the others, if you go down the chain, mid-cap IT companies have all reported pretty good order wins, and that's because cost optimization projects have been on the rise. Now let's talk about the guidance for FY24. Now, analysts expect both Infi and TCS to largely maintain their guidance, though for Infosys, the guidance at the upper end may come down. Earlier, it was 4 to 7%. It will come down to 4 to 6%, while HCL Tech's revenue guidance will be maintained, and both these companies are likely to hold on to their margin guidance. All eyes will also be on the new CEO at TCS, K. Krithivasan, as he took over the company from 1st of June. On Infosys, there have been a spate of exits over the last couple of months, which has got the markets a bit worried. In fact, Jefferies also expects a buyback from TCS this time around. Now, most of these stocks have recovered from their April lows. They've recovered anywhere between about 10 to 20% as the rate hiking cycle in the United States has come to an end. There's been strong economic data, which has kept hopes alive of a rebound in sentiment and spending in H2 of FY24. But analyst commentary and expectations is quite somber. Kotak says they're surprised with the resilience seen in many of the IT stocks. JP Morgan says June quarter is likely to be the weakest in a decade ex of COVID. Jefferies believes there are risks to the second half recovery, and this could drive earnings downgrades for this year. Morgan Stanley also echoes the Jefferies view, and they say that there are downside risks to the earnings expectations, but they believe that any cuts to consensus earnings forecast could leave the stocks within the coverage universe more attractive. UBS also says that on the valuation front, that the valuations currently imply a limited downside unless there is a meaningful deceleration, because the sector is trading at about a 6% discount to its 5-year rolling average, but they still are cautious on technology. Ambit would advise staying selective as Tier 1, Tier 2 valuations are still holding well above pre-COVID average multiples. And finally, let me leave you with the valuation plate. If you look at the valuations of IT companies right now, they're much higher than pre-COVID levels. They're much lower than the COVID level margins, and when valuations of IT companies had gotten re-rated. But largely, they are similar to the 5-year average, which takes into account a little bit of the pre-COVID and a little bit of the COVID period valuations.
Okay, all right, Rima, thank you very much. So, sobering thoughts there, and obviously expectations, which are pretty lackluster as well. I'll wait for Rima to join me back here as we get the conversation going with Ankur Rudra, ED Technology and Telecom Research at JP Morgan. Ankur, good morning. Great to have you on the show as always. We were looking at both of your notes that you shared with us. One tells us that the first quarter earnings season is going to be the weakest in a decade, ex of COVID, and that's a big headline. And the second note points out how it seems that the environment has deteriorated even further in June. Tell us more. I mean, is the street right now penciling in an earlier than anticipated or earlier recovery? And perhaps do you think those hopes could be dashed as we hear from the companies over the next month?
Thank you. Good morning, and thank you for having me. So I think, I'll frame the conversation in 3 ways. One, clearly there is, I think, an increasing appreciation that the demand environment has worsened in June. We've continued to see the trends that the sector faced in the month of March, which was actually a lot weaker, perhaps in the March quarter. So we think that will somehow come through, and we are expecting a June quarter which will be muted as a result of that. But moreover, I think not just that, I think there's been an expectation that demand and perhaps company performance might recover later in the year, either in the second half of the calendar or second half of the financial. And our conversations with the industry suggest that that may not happen. The demand uncertainty persists. I think enterprises are just not keen to commit to a recovery in the medium to short term. And the third way I'll frame this is in the context of the growth we've seen in the sector over the years. So clearly the sector enjoyed very strong growth momentum in 21, 22 as we were recovering from the post-COVID phase. However, I think the main thing here is we are seeing a mean reversion. We don't think F24 necessarily is an exception. It's a mean reversion towards long-term growth. And I think the question that investors should be really debating about is what is the long-term growth for the industry? We think it's about 7 to 8%, 6 to 8%, and not high single digits. So I think those are the 3 things I will sort of want to focus on.
Ankur, you raised a really important point, and I want to sort of delve a little deeper on the third aspect. Because if that is true, then this is not a sort of a passing phase and maybe some readjustments that are happening. For instance, I read an EY report which suggested, and they did a CFO poll around the world, and there 38% of the CFOs that were respondents, they were actually cutting back on tech spends or deferring or cutting back, and that kind of stood out for me as well. What you're saying seems to suggest that this is not a short-term 4, 5, 6 month problem. This is a mean reversion. Tell us a little more about why you feel so.
Sure. So, I mean, if one looks at the long-term trend of IT services growth for the industry and general globally, you'll notice that IT services growth tends to track global GDP growth quite closely, as the industry in India has grown dramatically. The market share for the sector has grown, and the premium of growth that Indian IT services can grow at has shrunk because of just the base effect. Now, one of the analysis we had done recently, we just tracked the total revenues for the entire IT services sector in India and compared what would have happened if there was no COVID. For example, from 2019, if we just extrapolated the growth rate over the last 5 years and look at what the growth rate would have been, our analysis suggested that if there was no COVID, the revenues for the industry would be pretty much what we saw in the March quarter. So basically, we were just going through a skew in spending. Spending was pushed out in 20, was pulled forward to an extent in 21, 22, and now we're sort of heading back to where the industry growth can be. And we think that's more like 6 to 8, 7 to 8%, and an expectation of growth going back to the the COVID years, I think is something of something that we would be very surprised to see, because the change that's happening, and to your point, I think a lot of CEOs, a lot of CFOs are realizing there is no urgency to tech spend right now. And hence, we sort of go back to the medium to long-term trends in terms of where people think about how much enterprises will spend on IT services.
So is there a risk that FY25 estimates also get scaled back, Ankur? Because currently the street is anticipating a rebound in FY25 with growth rates of 10%, at least on the top line, 10% and plus. Is there a risk that FY25 earnings also get downgraded? And also, what are your thoughts on the fact that the US economic data has been so strong? I remember what Rajesh had told me in April, and he said US is very quick to react on the way down and on the way up. So as soon as the economic sentiment turns, you see the US clients getting cautious, they turn off the spending tap. But the minute the tide turns and the sentiment improves, the confidence comes back, these US CFOs, CIOs, CMOs, they're very quick to spend. So if the economic data is strong, as we have been seeing, is there a possibility that client confidence comes back and spending picks up? What would you make of that argument?
Sure. So I think to start with, we do think that F25 estimates remain very high. We don't think the growth in the sector can go back to double digits sustainably. Like I said, we think the growth sustainably is about high single digits. And what makes us say this is I think we just looked at the long-term, medium to long-term trends. And the period that people tend to frame the focus on in a going back to double digits is basically looking at just the last 2 years. But if one looks at the long 15 to 20-year history, that's not been the case. Now, to your point in terms of the recovery in tech spend as the data improves. Now, what's different here is that when one looks at the data that we're looking at right now, that's consumer data. Indian IT companies, customers are enterprises. Enterprises have actually been going through an earnings recession. While there's not been a recession in the US so far, there still has been an earnings recession in the S&P 500. And that's what enterprises are reacting to. That's point number one. Point number two is when, let's assume that enterprises do see a better demand environment. Remember that IT services tends to be quite, a mid to late cyclical industry. So we'll see that with a bit of a lag. At the moment, there's no indicators to suggest that enterprise tech spend is improving.
Ankur, I want to understand whether you have started modeling in the impact generative AI is having on all of this. So my basic question is, for instance, Salil Parekh gave an interview to the papers a couple of days ago, and he said, Infosys could even look at acquisitions, maybe if they fit in for that strategy. So while you say that we'll revert back to maybe 5 to 7% growth, yearly growth at an industry level, what are you factoring in from the AI perspective and whatever disruption we need to be prepared for over the next 12 months?
No, I think it's a great question. So the way generative AI will impact the industry is clearly one of the questions, which is, I think, one of the key conversation or debate points among all, I think, industry participants, whether it's CEOs or whether it's investors. Our current perception is that this is clearly one of the big disruptors for the industry in the medium to long term. We think the first level of impact will be an element of deflation. A lot of the mid to low end work that IT services companies provide, whether it's application testing, to an extent application maintenance, infrastructure maintenance, business processes that can be partially automated, where one can see a significant amount of potential deflation on spending. In the medium to longer term, there should be more opportunities as industries evolve, as we move to higher levels of technology abstraction, as new work comes in. But unfortunately, that work typically does not come to IT services firms, or at least IT services firms with a technology heritage to begin with. It tends to go to consulting heritage firms to start with. So we think in the medium term, we would expect some deflation. It's very early to say what that level of deflation would be. It's hard to quantify right now. But we think that can depress growth in the medium terms, let's say 25, 26, 27.
Ankur, great conversation, but unfortunately out of time. Thank you very much for joining in and laying out your perspective. Get into a break on that note. On the other side, we'll get chatting with Midesh Thakkar for some technical trades. Stay tuned.
Welcome back. Here with us on Bazaar, and the listing has happened. We thought that EQ Lighting probably was the listing of 2023. Move over. IdeaForge has come in on the circuit. 90% listing pop. The stock has practically doubled from the issue price, which was somewhere close to, I think, 670. It's a drone company. The issue was oversubscribed 107 times. Rima, what do you say? And the timing, the sentiment, and obviously the space that they're in.
Yeah, and it's the first company since 2021 which has seen a subscription of more than 100 times, right? So just the kind of appetite the street has for drones, for manufacturing, make in India, it just ticks all the right boxes, and the stock straight away on day one has handsomely rewarded all the people who got lucky and got shares in the IPO. IdeaForge at 1,268 as we speak, which compares with the issue price of 672, a handsome 90% return. Mitesh Thakkar is back with us now. Mitesh, what a phenomenal recovery in the Nifty. We're in the green now practically for the Nifty and the Sensex at that 19,500 mark. Belying all expectations of a possible pullback due to global weakness. Your thoughts on the day so far and the calls?
Yes, so I think it's been a good day, no doubt about it. The morning gap down has been volatile, and I think that will keep on happening. My understanding is that the market isn't weak, and therefore I think we will see that all this decline will be brought into. The only thing is that I was personally, hoping that the decline will be slightly deeper and we could get closer to about 19,375, 380. But I think overall the trend remains on the upside, so maintain a long bias. On the stock side, I have two buy calls. In fact, the Berger Paints is something which is broken up. So buy here with the stop at 675 and a target of 715 can be looked at. And the other one is Titan, which is seeing good follow through buying post the gap up opening. So that's a buy with the stop at 3120 for targets of 3400.
Okay, all right, Mitesh, thanks very much. We'll keep connecting with you through the course of the day. Let's see how it progresses. Quick break right now. On the other side, our special segment, It's the Economy. Lata today gets chatting with Gautam Duggad, Head of Research Institutional Equities at Motilal Oswal Financial Services, to decode what lies ahead as the Q1 earnings season comes upon us.
Welcome back. Markets back in almost flat terrain. They have picked up most of their losses except for the Nifty Bank. But earnings season is upon us. And you just heard in detail about the IT sector. We now get you an overall preview of the earnings sector. Joining me now is Gautam Duggad, the head of research institutional equities at Motilal Oswal Financial Services. Good morning, Gautam. Pleasure having you with us. Thank you so much. Well, first, can you lay out the numbers? What are you all expecting in terms of an earnings growth in Q1 for your universe and for the Nifty?
Hi, Lata. Good morning. Thanks for having me. So this quarter basically is going to be a continuation of the trend that we have seen in FY23 as far as big sectors are concerned. Just an additional distortion this time because of what is happening to oil marketing companies, where you're seeing a substantial increase in profitability because of the marketing margins. So you have to keep that piece aside when you look at the aggregates. However, on a reported basis, we are estimating a 50% growth for our coverage universe in profits and 25% for Nifty. And as I said, if you keep OMCs aside, the growth is about 12 and 11% for Motilal Oswal coverage universe and Nifty earnings. Sectors that are doing well are the same that we have seen for the last 3 quarters, which is financials and autos, which is continuing the trend that we have seen starting from third quarter of FY23. Consumer is also expected to do well with about a 20% growth, largely a reflection of margin expansion. And we're expecting about 15% kind of a growth in IT as well as pharma. IT, however, is more a reflection of low base because the quarter-on-quarter trends are going to be quite muted as far as demand and commentary is concerned. And what is pulling down the numbers are basically global commodities like metals and then oil and gas, excluding the OMCs, which are showing a big decline. So metals, we are expecting the profits to halve on a YOY basis, and oil and gas also about 20% decline ex of OMCs. So that's how the overall picture looks like. There is going to be a margin expansion in many sectors, and I think this trend will perpetuate as we move forward in the rest of the quarters in FY24. Overall, we are still talking about a 20% kind of a growth in Nifty earnings, 16% excluding commodities for the full year FY24.
Okay. The overall Nifty, you have still brought it down by about 0.5% or something. That's what your report said. Any reason why you brought down your Nifty EPS expectation, albeit very marginally?
It's not even marginal, Broadway. It's just minor tinkering, Lata. So there's a 0.7, 0.8% cut in FY24 and 0.5% cut in FY25. This is largely a reflection of what is happening in metals profitability in the Nifty profit pool. So if you look at the absolute profit numbers for Nifty that we have, we've cut the numbers by about 5,000 crores in a total profit pool of about 7,60,000 crores, within which metals profits itself has got cut by about 12,000 crores. So rest of the sectors put together have actually seen a minor upgrade. So auto has seen a minor upgrade, oil and gas has seen a minor upgrade. Banking numbers are very stable. In fact, banking is still looking very strong, despite the percentage growth now shrinking because the base is very high now. So profit pool of banks itself, this year, we are expecting in Nifty to cross about 2.5 trillion and FY25 to about 3 trillion. I mean, that tells you the scale of the profitability now because 5 years back, entire Nifty's profit were 3.5 trillion. And in FY25, your financials profit pool itself will cross 3 lakh crores. So it's minor tinkering out there.
Okay. We are going to start with the IT companies. There you expect downbeat guidance as well. You've already mentioned that in terms of growth itself, IT companies are not going to do too well in terms of EPS growth.
Yeah, it's well into the numbers now, actually, Lata. In fact, our IT team believes that there can be a minor 100 bips tightening of guidance in Infosys. The quarter-on-quarter sequential growth on a constant currency basis is also going to be muted in tier 1 companies in IT. And there are some companies where we are actually expecting a quarter-on-quarter decline in the dollar revenue growth. So IT demand patterns are still very weak. Decisions are getting deferred on projects. And discretionary demand is also coming down there. So what you're actually seeing in IT is basically cost efficiency and vendor consolidation projects taking precedence over the digital transformation projects that we had gotten used to in CY 2021 and 22. But I think as the scenario gets clear over the next 1 or 2 quarters, these companies can come back because they've seen many such cycles in the past and valuations are already looking quite attractive. as far as large cap ID is concerned, because the NSE IT index has been underperforming since the beginning of CY22. But yes, the quarter is going to be muted for them.
Yeah, 16%, I think, earnings growth, according to your table. Well, Gautam, what about, banks? Your note seems to indicate that while you're expecting all banks to do well, your preference for buying is going to be PSU banks now.
Absolutely, Lata. That has been the preference for last 1 year or so. And in fact, in our model portfolio revisions, we've further increased the weight in PSU banks. So we had added Bank of Baroda a year back at 86 rupees in our model portfolio. Now at 200 rupees, we further increased the weight from 2 to 3%. The reason is very simple, Lata. In fact, this quarter also, if you see, while we're expecting a very strong 30% plus profit growth in private banks, we're expecting the profits to double in PSU banks. However, you have to keep one thing in mind when you are looking at financials numbers now, because quarter on quarter now, the growth will moderate. PSU banks will have 1 or 2 quarters more of a low base benefit, but private banks already you will start seeing numbers getting a bit more moderate. In fact, for the fourth quarter of FY24, we're expecting the PSU banks to report just about 10% profit growth and private banks to report about 12% profit growth. But overall, valuation, growth, balance sheet, ROE, overall asset quality framework, if you see, there's no doubt in my mind that the sector deserves to have a big overweight. And that's what we've done actually. Okay. We've increased the weight in NBFC further in Mahindra Financial, which we had added 2-3 months back. The stock has done actually very well. It's up 50% since when we added in April. And our conviction remains quite high there. So we've increased the weight further there. So financials and consumption are two sectors where we have further increased our overweight stance and increased it in a very big manner.
Okay, and you, besides MMFSL, you're also adding Piramal, I think, to your portfolio. So NBFCs are going to better than banks?
I think so. See, because in NBFC, it's slightly more of a tactical and an alpha trade. And post-April, when it became clear that RBI is going to pause on the monetary tightening, it augurs quite well for NBFC from a trading point of view. And that is when we started increasing weight in NBFC. If you see the end quarter disclosures of many of the NBFC companies you come in, the AUM growth, disbursement growth, I mean, you've seen the disclosures of Bajaj Finance, you've seen the disclosure of Mahindra Financial and a couple of other names. It's pointing towards a very strong quarter. In fact, in NBFC itself as a pack, we are expecting a 30% profit growth. And plus the fact that rates are going to either remain stable or ease at some point of time, it does provide some sort of a cushion to NBFC valuations. And despite the run-up, in NBFC, you still see some room for upside out there. So which is why we are tactically raising the weight in NBFC further. And in some cases, where the stocks have run up a lot, we are also using the opportunity to reallocate money. So for example, we'd added Poonawalla, I think 6 months back, and the stock is up more than 50% there. So there we have replaced it with Piramal. So some of those tinkering and trimming and reallocation we have done in the model portfolio, but overall, the view remains extremely sanguine on NBFC.
Just today, or maybe this week, it's a little not very easy to believe that interest rates are going to go down. We have seen a 20 basis point increase in interest rates over the past 2 weeks. If you only looked at the bond market, clearly led by what's happening in the US. But I take your point that RBI cut is not expected or a hike is not expected. Gautam, will the mid-caps wow? Because we've seen a very strong run-up in mid-cap stocks in the past, in 2023 itself, 19% was the index rise. So do you expect a wow number in some of the mid-caps? Can you alert us to which ones?
So Lata, while a lot is being made of the recent 20% move in the last 3 months for a mid-cap and a small-cap index, if you take a step back and look at the overall performance of these indices over the last 5 or 6 years, the small cap index is compounded at a measly 7%, whereas the mid cap index 5 or 6 year compounding is just 12%. It's because of the last 3 months of the rally, it seems that there is a lot of euphoria. But the fact remains that over a long period of time, at least in the recent past for the last 5-6 years, the returns have been abysmal. Now, coming to your question on mid caps and small caps, they are always a bottoms up trade. You cannot basically categorize them sector by sector. So in every sector, you will find ideas where some mid caps and small caps will fly. For example, in hotels, we are expecting very strong numbers, which is why you were seeing two hotel stocks in our model portfolio for some time now. Real estate should have a very strong quarter once again. Something in the consumer discretionary, you have seen the numbers of Titan as well as Kalyan, right? We've in fact added DMart in our model portfolio. We've added Zomato in our model portfolio. So a lot of these sectors will have some segments of mid caps where numbers will look extremely strong. But again, you cannot categorize them in a basket of a sector, because every sector will also have some mid caps and small caps, which will disappoint. So you clearly have to take a more bottoms-up view when you are looking at mid cap and small caps. But yes, I do believe that a lot is being made of the last 3 months of a rally. If you take a slightly longer-term picture, the returns of these indices have been quite average.
Okay. Well, just one final question. A lot is being made about power and smart meters lately. We hear that conversation. You're not swayed by them, not adding those companies?
Unfortunately, right now, we don't have a coverage on them. But yes, manufacturing and overall infrastructure thrust that the government is giving, and again, the recovery in the private capex cycle that we have seen for the last 2 quarters, we expect that trend to further reinforce going forward in FY24 and 25. And therefore, there will be a lot of subsegments of renewables on infrastructure side, on overall capex side, which will come back into vogue. Some of these spaces or subsegments have been completely absent in the investor conversations for almost 10 years. They've come back into vogue only in the last year and a half. And I expect that the private capex cycle to strengthen even further from here, and will open up a lot of opportunities in many of these unique and niche subsegments. And therefore, it makes sense to have a slightly higher allocation towards manufacturing and capex side of the overall portfolio.
Okay. That's an excellent overview you have given us and prepared us for the upcoming earnings season. Thank you very much, Gautam Dugal, for an extremely comprehensive report that you have presented. Excellent report, must-read report, and of course, the numbers there. And wrap up on Bazaar on that positive note. Chartbusters up next.